Welcome to this section on preparing the financial statements. Once your adjusted trial balance is final, the real story begins. Numbers in a ledger mean little until they are organized into statements that an investor, a lender, or a regulator can actually read and trust. Over the next several minutes, you and I will walk through how the balance sheet, the income statement, the statement of stockholders' equity, and the notes come together under United States generally accepted accounting principles. Think of this as the moment your close work becomes a finished, GAAP-compliant product. Let us begin. Before we dive in, let us agree on where you should land by the end. You will be able to build a classified balance sheet that separates current from non-current items under the Accounting Standards Codification, which we call a SC. You will structure an income statement and present comprehensive income correctly. You will calculate basic and diluted earnings per share, often shortened to EPS. You will roll forward every component of stockholders' equity. And finally, you will assemble complete notes supported by a disclosure checklist. Keep these goals in mind as we move through each statement together. Why do we bother separating current from non-current items at all? Because readers need to judge whether you can pay your bills as they come due. The balance sheet, also called the statement of financial position, reports your assets, liabilities, and stockholders' equity at a single point in time. Under a SC 210, the classified format splits assets and liabilities into current and non-current categories. Current means you expect to convert an asset to cash or settle a liability within 12 months of the balance sheet date, or within the operating cycle if that cycle runs longer. This simple split is what makes liquidity visible. Next, let us look at what actually sits in each bucket. So where does each asset go? Your current assets include cash and cash equivalents, short-term restricted cash and investments, accounts receivable shown net of the allowance for doubtful accounts, inventory shown net of the obsolescence reserve, and prepaid expenses. Notice that receivables and inventory are presented net because readers want the realistic value, not the gross figure. Your non-current assets include property, plant, and equipment, which we call PPE, shown net of accumulated depreciation, right-of-use assets, which we call ROU assets, intangibles net of amortization, goodwill, equity method investments, and deferred tax assets. Classifying each line correctly is what keeps the statement honest. Now turn to the other side of the ledger. On the right side, current liabilities cover accounts payable, accrued liabilities, the current portion of deferred revenue and long-term debt, current operating lease liabilities, and income taxes payable. Non-current liabilities hold long-term debt net of issuance costs, lease and pension obligations, and deferred tax liabilities. Stockholders' equity then rounds out the picture with common stock at par value, additional paid-in capital, which we call a PIC, retained earnings, accumulated other comprehensive income, which we call a OCI, and treasury stock presented as a contra-equity deduction. One reclassification matters greatly here. Debt due within 12 months must move to current, so always prepare that reclassification memo carefully. Is the classified format the only option? Not quite. Banks and financial institutions may instead present assets and liabilities in order of liquidity rather than the classified split. Whichever approach you choose, you must disclose it and apply it consistently from period to period, because consistency is what lets readers compare you over time. Speaking of comparison, GAAP requires a comparative balance sheet showing at least the prior period alongside the current one. If you report to the Securities and Exchange Commission, the SEC, you must show 2 full years of balance sheets. Always tie every line back to the adjusted trial balance. With the balance sheet set, let us move to performance. Now, how did the business actually perform? The income statement, also called the statement of operations, presents revenues, expenses, gains, losses, and net income for the period. Under a SC 220, the structure flows logically. You start with revenue, net of discounts and returns and recognized under a SC 606. Subtract cost of revenue to reach gross profit. Subtract operating expenses such as research and development, selling and marketing, and general and administrative to reach operating income, also called EBIT. Then add other income and expense like interest and foreign exchange. Subtract income tax expense, and you arrive at net income. This top-to-bottom flow tells the earnings story cleanly. For public companies, one number gets watched more than almost any other, and that is earnings per share, which we call EPS, governed by a SC 260. Basic EPS divides net income available to common shareholders by the weighted average shares outstanding during the period. Diluted EPS goes further by adjusting both numerator and denominator for the effect of dilutive securities such as options, warrants, and convertible debt, showing investors the worst case if those instruments convert. There is one important guardrail. Antidilutive securities, those that would actually increase EPS, are excluded because including them would overstate your results. Always present both basic and diluted figures. What happens when part of the business is sold or shut down? If a disposal represents a strategic shift, a SC 20520 requires you to present it as discontinued operations, separated from continuing operations, with prior periods restated so readers can compare like with like. This keeps your ongoing performance from being muddied by one-time exits. You should also know what no longer exists. The extraordinary items category was eliminated by Accounting Standards Update 2015-01. Items that are unusual or infrequent may still appear as a separate line, but they stay within income from continuing operations. Getting this presentation right protects the integrity of your earnings trend. Some gains and losses do not belong in net income at all, and that is where other comprehensive income, which we call OCI, comes in. A SC 220 gives you two presentation options. The single statement approach shows net income and OCI in one continuous statement, while the two-statement approach uses a separate income statement followed by a separate statement of comprehensive income. Both are acceptable if disclosed and applied consistently. OCI captures items that bypass net income and flow directly to equity, including unrealized gains and losses on available-for-sale securities, which we call a FS, the effective portion of cash flow hedges, which we call CFH, pension adjustments, and the cumulative translation adjustment, which we call CTA, present every component net of tax. How did each piece of equity change during the year? The statement of stockholders' equity answers that, and it is required for all GAAP financial statements, private and public alike. Common stock changes only when shares are issued, such as in an offering or option exercise, or when shares are retired. Additional paid in capital, a PIC, captures the proceeds from issuing stock above par value, and it is also where stock-based compensation expense is credited, with the matching debit landing in the income statement. By rolling each component forward from its opening balance, you give readers a clear bridge from last period to this one. Let us continue with the remaining components. Let us finish the equity roll forwards. Retained earnings equals the beginning balance plus net income minus dividends declared. Retrospective principal changes adjust opening retained earnings, and error corrections trigger a restatement of that beginning balance. Accumulated other comprehensive income, a OCI, rolls forward as beginning balance plus current period OCI net of tax, less any amounts reclassified to profit and loss, tracked by each component. Treasury stock under the cost method is recorded at cost as a contra-equity deduction, and on reissue any excess goes to a PIC. Dividends are recorded on the declaration date, debiting retained earnings and crediting dividends payable, then settled in cash on the payment date. Every roll forward must reconcile back to the balance sheet. Why do the notes matter so much? Because the notes are an integral part of the financial statements, not an appendix, and they supply the context that makes the numbers understandable. You begin with a summary of significant accounting policies covering consolidation, revenue recognition under a SC 606, depreciation, leases, taxes, and key estimates. From there, you provide disaggregated revenue, segment reporting under a SC 280, income taxes under a SC 740, debt schedules, lease disclosures under a SC 842, the fair value hierarchy under a SC 820, derivatives, commitments and contingencies, and the EPS reconciliation. These disclosures turn raw figures into a complete, defensible picture of the business. One last category can change your statements right up to issuance, and that is subsequent events under a SC 855. These are events occurring after the balance sheet date but before the statements are issued. The treatment hinges on timing of the underlying condition. A recognized event reflects a condition that existed at period end, so you adjust the financial statements. A non-recognized event reflects a condition that arose only after period end, so you disclose it but do not adjust. Finally, a comprehensive disclosure checklist compares required disclosures against those included, and legal and tax review it before the statements go out. This final gate is what protects you from a missed disclosure. Let us bring it all together. You now know how to build a classified balance sheet under a SC 210 and tie every line to the adjusted trial balance. You can structure the income statement, present comprehensive income, and calculate both basic and diluted earnings per share. You can roll forward common stock, additional paid in capital, retained earnings, accumulated other comprehensive income, and treasury stock so they reconcile to the balance sheet. And you can assemble complete notes, run the disclosure checklist, and evaluate subsequent events through the issuance date. With these skills, your close work becomes a polished, GAAP-compliant set of statements. Thank you for completing this section on preparing the financial statements.